All right, let's start. First off, again, this is Mitch Rosen, Senior Director, Head of Real Estate at Yieldstreet. Thank you, everyone, for joining us. We are here today joined by our esteemed guest, Jerry Sager of First National. Jerry, how are you today?
Doing well. Good to see you, Mitch.
Good. First off, I want to make sure that everyone's doing well, happy and healthy, looking forward to spring. I want to introduce Jerry briefly and talk a bit about his background. Jerry Sager is the Senior Managing Director of First National, a lender that provides bridge, construction, and refinance capital to various esoteric assets, including golf courses. Golf lending has been a major investment for First National and for Jerry over his 35-year career in banking. Jerry and his team at First National wrote the basic criteria for which today most agencies utilize for assessing certain special golf-related assets. And over the past 3 decades, First National has underwritten over $2.7 billion of specialized real estate and golf-related assets. Jerry, thank you for joining us today, and welcome to the Yieldstreet podcast.
Good to be here.
I got a lot of emails and calls in anticipation of this webinar. Golf is a sport that people feel very passionately about from a personal, leisurely standpoint. But when you talk about it in the context of commercial real estate, right, and lending or investing, you have your traditional 5 core assets, right? Multifamily, industrial, hotel, retail, office. You don't think of golf as one of those asset classes that maybe would fall into that purview. And so I guess high level, tell us about how you got into the golf lending business and what about it have you found attractive over the years?
Well, it's interesting, and you're right. So many people just enjoy the game of golf. They're enthused by it. They want to be out. They want to play, and they fall in love with it. And I can understand why. When you look at it from an economic standpoint, this is something that creates an $84 billion cash into our economy every year and in excess of 2 million jobs. So it is an economic driver in our economy, and it does support a whole different asset class for investment and for real estate lending. For me, it was simple. I started out as a lowly investment banker 30 odd years ago, and a real estate transaction came forward and it was surrounded by golf. And we looked at it and we said, wait a minute, this is 200 acres of a bunch of empty land with some flagpoles in it. Does it really qualify as real estate, or is it a cash flowing retail business operation? And how do we analyze it? So we took bits and pieces apart of what made this business function. It's greens fees, it's food and beverage revenue, it's cart rental, and we decided, gee, with this kind of NOI and this kind of debt service coverage, we can create a debt structure out of it, and did our first golf course loan, actually 35 years ago. Once you do one, you become an expert. So suddenly
Right.
we're doing more and more golf course loans. So that was the foundation.
That's a great start because it falls into the category of certainly we use the word esoteric a bit, right? It's not the core classes, but it does kind of probably fall a bit more into maybe the hospitality or leisure segment, if you will, right? There may be some seasonality to it. It's a daily lease rate effectively. It's run more like a business than it is, there's no long-term tenants as in a retail property or an office property. A lot of trends have been spoken about golf the last 10 years, particularly post the recession of '08, right? There were so many golf courses, the post-Tiger boom, if you will. Tell us about some trends in the golf space that you've seen and how that's impacted the way in which you lend or invest in the golf space now.
There are a couple of things that have happened. If you look back in the industry to the turn of the century, somewhere around 1999, the year 2000, there were close to 20,000 golf properties continental United States. Today, there are only 16,500 properties that function in continental United States, and they function in about 5 different ways. They function as destination resort properties, a different business analysis. They function as private clubs owned by members. They function as municipal clubs. They function as semi-private, and they function as daily fee clubs. All 5 different businesses and all different ways to analyze them. If you go back just a few years ago to 2006, we had 29 million core golfers, a core golfer being someone that played regularly. And that number's inverted itself. And today we only have 24.3 million. So supply has gone up and demand has gone down. And you just can't argue with those numbers in spite of how much we all love the sport and think this is just a great business to be around. And one comment to your side of it, Mitch, to the seasonality of it, there's positive and negative to it. You can have a golf course operation in Michigan, for example, that produces terrific NOI and becomes a very positive investment because of participation rates. And part of the factors that influence it is the golf course is indeed shut down for 4 months. So you don't have heavy overhead versus a golf course in Dade or Broward or Palm Beach County, Florida, that needs to operate 12 months out of the year and absorb that overhead. So you need to look at golf in continental United States, in our opinion, as though our country was divided into the form of a tic-tac-toe bar with 9 separate geographic regions or markets.
Interesting. Okay. And so you're actually saying that it's not necessarily a negative if in fact you're in Michigan and you're closed for 4 months because of the cost savings you have and the increased use during those core open periods effectively.
No, not at all. We've looked at audited financial statements on a couple of golf course operations in the northeastern section of the United States and the Midwest that have produced incredible NOI and make for wonderful investments and, quite frankly, wonderful loan objectives.
Right. Okay. Exactly. So it's not necessary to say that if you're open 12 months a year, you're going to perform better. That's the conclusion you're reaching.
Correct. Absolutely.
Got it. Okay. Right. So take us through how you think about and evaluate. You mentioned the 5 segments within golf, right? Municipal, semi-private, the daily, the private, and I forget the 5th one, but talk to us about the ones in which you've lent against, which ones you would lend against these days, and what do you look for? What do you avoid? What lessons have you learned as you've invested the tens of hundreds of millions of dollars that you've done in this sector, which not many people have experience doing?
Well, I think the first thing we learned early on, and that was never to fall in love with an asset. And it's so easy to do. You go out to due diligence a property and it's a beautiful spring day and you decide to play golf and everything is wonderful and the golf course was designed by one of the top architects in the world and you can't imagine that anything could be more perfect. That was our first mistake. And we said, look, this is actually a retail cash flowing business. It's not about golf. It's all about NOI and it's all about debt service coverage. And let's look at that. So what we learned was to look at it not as though it were golf, but to look at it in its truest sense, a retail cash flowing business. And if you look at our country, you see a large concentration of available properties, for example, in Myrtle Beach. Those properties are very dependent on the tourist trade. And it's a question of how much tourism can you generate to generate X amount of revenue to each one of those properties to make them viable as either an investment or a loan. So we started breaking out the country in demographics and we reached an interesting conclusion. We said, you know what? Golf is kind of like having a supermarket. You're not going to build a Publix next to an A&P, next to a Wegmans, next to any other market. We do that in golf. We don't do it when it comes to supermarkets. So we started analyzing in that very way.
And so the conclusion being that if you build it, they will come, which may be a bit of mantra from 99 to 2010. Your point is that basically quickly fell away and that the competition and the lack of users basically killed those businesses or put them out or, changed their owners, wherever it may have been.
Well, your statement's actually 100% correct, because what did happen during that decade was a lot of golf course developers went out to unusual locations and they decided to build a magnificent golf facility with a terrific designer. And candidly, they were beautiful golf facilities and they were going to sell high-end homes surrounding them. And everybody seemed to have forgotten about the numbers. It becomes a question of how many people can actually visit Jackson, Wyoming at any given point in time And of those number of people, how many of those, and I don't mean to say anything derogatory about Wyoming, but statistically, if you sell 260 multi-million-dollar homes surrounding a very expensive golf course with very high-end food and beverage, how many members and how often are they there and how does it support itself? It's a supermarket. How many people are going to go to the cash register and buy their can of soup?
So let's talk about the different kinds of golf product, right? You mentioned destination resorts, right? So a hotel with a golf product that, is part of the reason why people may travel down to go there, right? So you think of like PGA National as an example, right? With multiple courses. And then think about home sites, right? So in Florida, I think, and I correct me if I'm wrong, most of my parents' age folks don't actually want to join a 50 and older community with a golf course. They don't want to deal with the cost inherent in supporting it, maybe the HOA charges to utilize it. There's so many options available to them that are not annual contractual agreements. They can just go and play per day, like you said, per diem. Why bother with having it? So are you seeing a trend away from golf in that context?
There are two things to consider, and we're numbers focused people here. The first thing to consider is the aging population. And where is that population going to be vis-a-vis the population or the generation that follows them? A lot of people in that aging population are willing to subscribe to the lifestyle commitment of the communities you've just described. Then it becomes a question as investors and bankers, how long does that business model continue? Will the 45-year-old with a wife and two children follow their parents into the same mode of living as they face 55 and 65? We think the answer is no. And we think there's an oversupply. Will those people likely move to warmer climates and warmer environments for tax advantages and a plethora of other things? Yes. Does that create an opportunity in the industry? Probably does, if you can buy the right or invest in the right golf property and think of a way to reconfigure it or build more houses because you already have the structure of the operating community, and it becomes a profitable investment. You just need to be careful and do your demographic research.
Right. So let's talk about demographics for a bit. You mentioned number of golfers. You mentioned the drop in number of golf courses. Are those trends continuing to play out, and do you foresee them continuing to play out looking forward 5, 10, 15 years? Golfers dropping, number of golf courses decreasing as well, and then maybe an inflection point where it stabilizes a bit. I think about my own friends, my own contemporaries of my own. Many of them play golf. I'd say they play an average 5 to 10 times a year. It's not a every week thing. They all have young kids, it's under the age of 15. I think in the generation of speaking in stereotypes now, at my parents' generation, maybe in your parents' generations, the dad would go and play golf, on a Sunday for 6 hours and have lunch at the club and come home at 4 o'clock. It's just not, I think parenting has changed a bit. And I think the utility of golf has also changed a bit. Do you think that's at all more anecdotal or actually bears itself in the numbers that you see?
No, I actually think it bears out with the numbers, because if you take the state of Florida, for example, has 1,250 golf courses. The vast majority of those are centric to the southeastern part of Florida and a few spotted communities on the western coast. If you then look at those communities and you look at the average age of the profile of the person that lives in them, that profile has increased from an average of 60 years old a decade ago to now an average of 71. And younger people are not moving to those communities because, quite frankly, look, I want to do it myself. I want to cycle. I want to do other things. I don't want to spend 4.5 hours away from my wife. There are a whole plethora of things I would rather do, and I'm physically much more active than my parents' generation. So the perfect example is a good friend of mine who worked for a competing bank and wanted to buy a home in South Florida. And he came to South Florida and he looked at 5 separate self-contained destination residential golf course communities. Gentleman was 51 years old and could easily afford to go wherever he wanted. He made a decision not to live in any of those communities and join a private self-standing golf club for from his viewpoint, for $10,000 less per year of overhead. So in a lot of
Wow.
respects,
Okay.
in a lot of respects, I think in some ways that section of golf is a failed business model. The antithesis of that is I think it creates interesting opportunities for the right loan structure and the right investment.
So let's talk about the numbers now for a second, right? So you think about incremental yield to invest in an esoteric asset class like golf. So give us a sense, if you don't mind, very broadly speaking, not talking about a specific opportunity, but more about just your experience the last 20 years. How much incremental yield do you think you can earn from a golf loan? And what are you giving up, or how high are you increasing your risk profile? I know I've heard you say that you actually view golf as safe as some other asset classes that I would traditionally think as core CRE asset classes. You love the golf space. Tell us why that is. What has your experience shown about defaults or non-payments, workouts, liquidity, all the things that you would look for in a commercial lending seat?
I think there are two answers to it. The first answer is if you look at that market generically, broadly, across the spectrum, excuse me, I think the risks are high because I think a lot of people make very serious underwriting mistakes. They don't get the right appraisals, they don't analyze the business correctly, and that increases the risk. If I look at our risk, and sure, we've had defaults and we've had issues over the years, we've managed to work out those issues because we look at the marketplace and we choose assets that are in highly restricted entry markets. So if our asset goes into default and our LTV is relatively low, we can liquidate quickly and recover our investment plus a yield by merely selling to someone who's close in the marketplace. I mean, this is a somewhat incestuous business. If we go back and we say, look, there are 16,500 courses continental United States. The largest two single operators of golf courses have less than 300 properties each, which means,
wow,
the vast majority of these 16,000 properties are owned by single operators. They're not owned by large operators. They're not managed by large operators. And if they're in the correct infill markets with the right restrictions to new entry, i.e. getting 150 acres to build a new golf course or more, your risk profile continues to decrease. So it's all about the underwriting, and the yield is a given. Look, there are not a lot of people in this asset class right now and in this space. Therefore, spreads widen and yields are attractive.
Tell us about the kind of demand you're seeing these days. There's been a conversation we had offline about how COVID's been, in some ways, a huge tailwind for golf, right? People are looking for activities that are outdoors, safely distanced, and still able to communicate with other folks in a safe way. And that could be obviously a continued tailwind, I would say, for golf looking forward, because I don't think COVID's going away forever, per se. Have you seen that bear out in the numbers on the loans that you've made against properties?
Yes, actually, it's really kind of fascinating. There's so many people in business and industry over the last 12 months that are now working remotely. In addition to that, your point is spot on. It could not be more spot on. People are going out to golf courses. They're socially distancing on golf courses rather than riding in a cart with a compatriot. They're either walking or they're riding alone, and by riding alone, it's increasing revenue to the course as well. Operating incomes on a lot of properties has actually escalated. I'm not bright enough to figure out whether COVID's going away in the next 90 days or 9 months. I do think what will happen is there'll be a peak and a stabilization to golf participation yet again, and perhaps a slight decline.
Got it. So I have really good couple of questions here. Let's tackle them. The first one says the following: understanding that there is a limited capital pursuing these assets. When assets do come to market, what kind of appetite is there, and what kind of cap rates would they trade at? How do you think about this versus a hotel product or an office product, a multiple of NOI? How do you think about that? What do you see in the marketplace?
Well, let's go back to the 9 regions we discussed earlier. It really is incredibly dependent on the region. You're seeing aggressive numbers vis-a-vis participations in, surprisingly enough, the Midwest, in the Chicago, Michigan, Illinois marketplaces. It's an odd phenomenon because participation rates are showing those properties being highly utilized in excess of 40 to 45,000 rounds a year. If we backtrack a little bit, the average is now about 25,000 rounds a year. So that's an amazing increase. But the antithesis is in South Florida with so much product, it's inverted. So we're looking at bargain purchases on a lot of properties, but long-term to convert them or do something else with them. Hopefully that answers the question.
So on the ones where there is cash flow and it's not, the play is not the redevelopment play, what are people, are these trading at 10 cap rates? Are they trading at 8 cap rates, at 5 caps? Like, what, give us, if you, a broad sense is fine.
Yeah, it's surprisingly, it's actually all the way across the board. We've seen things from as high as a 10 multiple of NOI to as low as a 2 times. Really dependent on how the buyer perceives the upside potential. And look, I'm the dumb baker. I'm not the guy out there appraising the golf course property, so I can't really assess the rhyme or reason behind it.
But you've seen properties trade as much as a 50 cap effectively at 2 times multiple of NOI.
Yes, with audited, I'd be happy to share with you privately what the property was, but it had 54 holes of golf, audited financial statements. It was putting a very healthy 7 figures to the bottom line every year. And there are 3 or 4 major sources of revenue. The first major source of revenue is actually cart rentals. The second is greens fees. The third, way down the line, is food and beverage. And then we get into pro shop revenue and a plethora of other things.
Got it. Interesting. So in that particular case, what was it about that property that people were hesitant to pay a higher multiple on?
I think it was the location and the perception of upside and longevity of the income stream. You know, golf is an odd capital asset. It is CapEx intensive. You need to support the turf grass revenue. You need to support the irrigation system. You have a high maintenance expense on the equipment. You've got a building that you need to maintain of typically between 30 to 45,000 square feet. So it is CapEx intensive.
Yep. That's a very good point. The second question we have here, one of them disappeared. Hold on, let me find it again. Apologies. For new asset class like golf, this is more to me, how would Yieldstreet underwriting get up to speed? It's a great question. And it's asking really me, Jerry, about how do we think about the golf space? The fact is that, we have limited experience in golf lending. And the fact is that we would look to partner with someone like Jerry, who does have a 35-year track record in it, looking at their track record, what they've done, and how to underwrite it. At the end of the day, it's still numbers, right? We're not trying to create a new paradigm of way of thinking about cash flows. And there are guarded financials that go back years, right, Jerry? I mean, like you could look at 3-4 years of numbers, right? So you can see the trends, you can see the cash flows. I think no matter what product you have, that FMV business can be a huge driver of revenue, but not much of a huge driver of NOI. Costs are high. Your product spoils. Your costs for labor is high. So if you're doing it for more of a catering business, I think we've spoken before, Jerry. You said it's not really the best way to go. It's really about just the numbers.
I think it's absolutely about the numbers, but that doesn't seem to stop a large number of people that fall in love with the asset and just want to own a golf course. They want to be in the asset class. They feel the need to be there. And we have a pretty standard question when we meet those people. We ask them simple questions like who the architect was at Pine Valley or Baltusrol or some of the other more famous golf courses. And if they can answer that question, we're perhaps a little more ahead of the game. Or if they know the difference between dollar spot or chinch bugs and how we treat those turf grass diseases and what the cost is of the repair of the irrigation system, then we feel more comfortable.
Got it. I got it. Yeah. A follow-up question was from the gentleman who asked the question earlier. How do the returns compare now to where they would have been 5 years ago? So that same property with healthy cash flows, 7 figures, nice property, 54 holes of golf. That's an extreme example, obviously, but is it a fair comment to say that cap rates have widened in the last 5 years as the number of players has gone down? Or is it too broad a statement to say that?
I think it's a little bit too broad a statement. I think you need to be focused. If we go back to the very property you just spoke about, what's happened to the NOI? If the property is correctly managed and the market is well managed, the NOI will continue to increase. And in many instances, spread will widen as management improves.
Okay, got it. And is the appetite for people buying golf assets still there? Meaning, 5 years ago, if you put a good located, well cash flowing asset up for sale vis-a-vis a broker, and you had 10 folks show interest, do you think those same 10 folks show up today? Not the same exact 10 folks, but 10 folks show up in general to show the interest? And is the competition for those assets still attractive? Is it still strong?
I think the same 10 type of people show up. I think it's as equally strong, and in many markets, surprisingly stronger. I think a lot of bright investors are looking at properties and they're saying, gee, if we invest our dollars and we keep our dollars on the table for 24 to 36 months, can we reposition this deed restricted piece of property and develop it into something else? And if we do that, is there a market for the development? Is there a market for single family homes or low-rise mid-market condos? And if we think there's a market there, is this an asset worth buying, operating for 2 or 3 years while we achieve those permits? And you need to be careful. It's a serious issue of making that decision in the right community. If that golf course is in an infill community in a megapolis marketplace, easy answer, everybody wants the tax rateables, and we'd rather have some single family homes, and we can give up a little bit of green acres if we configure the asset correctly. If that property is built far away from anywhere, and as you said, if we build it, they will come, and they never came, maybe you never need to make the investment.
Yeah. I have one more question myself. I want to answer a question that someone else put in here. Jerry, this is for you. Do you see any trends in golf around aggregator memberships, a la Icon, Epic passes, and skiing? And if so, how does that trend impact your outlook on the ownership investment in golf real estate? Or what would need to change from an operator perspective to accommodate that trend? I do know that there are similar products like that. I have a friend who works for, oh my God, I forget the name, but a very similar product where they would basically pay a fee to get you on certain courses. What's your view on that question? I can repeat it if you want.
It's interesting. That's been tossed around for probably 15 years. There are a number of golf properties that if you join, for example, our former president's management group, and you join one of their courses, you have rights to play on other courses, and there are exchanges and a plethora of other things. It was tried as well by a developer who started in Rockland County, New York, and built in Somerset County, New Jersey. It's never seemed to get the traction that one would anticipate. There always seems to be this odd marketing concept of golf that individual golfers want to go to my club, in air quotes, my club, and feel at home. And if they're going to travel, well, we want to go play Pebble Beach, or we want to go to Bandon Dunes, or we want to go to another well-known high-end destination property. And then, of course, you need to look at the numbers as to how often does somebody return to Pebble Beach or Bandon Dunes or PGA West or any of the other destination properties specifically to play golf a second or a third time. The answer may really surprise you.
So the conclusion, I guess, is that it's been talked about a lot. It's not really taken traction. It's not really gotten much traction. That's because people want to say, hey, this is my golf. They want an affinity. I want a community. They don't want to just kind of travel and play at different spots. Okay, that's interesting.
Correct.
Right. Here's a question I had for you. This is a personal one I had. How do you think about the environmental impact of golf, the fertilizer, the watering, particularly in locales where, you wouldn't inherently think to just build a huge area of grass in a desert. Palm Springs in California. California has had droughts off and on the last 10 years. Arizona, Nevada, Utah. do you have any sense that if the cost of, there's some pushback from the user base, particularly around ESG, right? ESG has been a very hot topic nowadays. If the cost of water was penalized for those users, I don't know. It's just something that someone in the office asked about golf, who's not a golfer, nor am I. But when there's the environmental toll that golf does take, it kind of begs the question a bit: do we need 16,500 golf courses in the country?
Well, it's actually a serious issue. It's been ongoing for about 12 years. A lot of existing and prior chemical treatments to golf properties had contained high densities of arsenic. That's created environmental issues to redevelop the properties. There are surprisingly issues with fuel oil spills in the maintenance area, also created an issue. And then, of course, water is an incredibly big issue. We look at that seriously from an investment standpoint because the supply of water is what helps generate or germinate the turf grasses. So it's where does this property acquire its water and at what cost? And if they have wells, how deep are the wells and how is it affecting the aquifer and where will it go from there? It is a more serious question than you might imagine, and it's affected, I'm guessing, a much larger number of properties than one might imagine at this juncture.
Wow, I'm happy I asked that because I didn't expect that answer. I expected there to be some talk around it, but I didn't quite understand how relevant it is now, particularly with regards to access to water, wells, aquifers. Pumping out of the aquifers, you're going to cause other problems. There's repercussions of that pulling. So that's very interesting. I got a question from housing around golf courses, homes. Does that play a factor in a lot of the high-end courses are now communities that the housing market is booming? Like, this is kind of tied into my question from earlier, but about, are buyers agnostic to the golf component? You mentioned your friend who looked at 5 different clubs, picked one without it, and joined a country club. With right now, with where the migration demographics are moving to, the smile states, right? Looking California, Arizona, Texas, Florida in particular, and up the coast. Do you think that as people migrate down there, that golf will be a value add as people move down? Will it be a deterrent? Will it continue to buttress home prices, or are people agnostic? What do you think about that?
There's been some minor change and minor shift, and it's a very broad question, but let me go back. Most of the properties you're referring to, golf was there as an amenity, solely as an amenity to sell houses. And what's interesting about it is houses initially statistically sell on the golf course, on the fairways, by the greens with views, etc., at a much higher value than they do away from the golf course in the same community initially. When they resell, they actually sell for less dollars. The reason being is most people don't want to wake up at 8 o'clock in the morning listening to mowing equipment, maintenance equipment, or some interesting anomaly from some golfer that went, oh, and just filled in the blanks. So that's happened.
That's really interesting.
I can think of one development that's building a little more than 4,100 homes in the state of Florida. And they are building their higher end community within their PUD with a golf course. But the developer is not building a golf course. A separate golf course operator and developer is just doing the golf course. The land was gifted to him for nothing. So he has a zero basis. It's there specifically to sell higher end homes around the golf course in the larger PUD, and the developer of the golf course will share in the upside of the revenue from the higher end homes. So that profile has changed in the last decade.
So who will pay for the development of the course itself? The operator?
The developer will build the golf course, although he's received the raw dirt for nothing. And that golf course will be deed restricted and is grandfathered in as green acres to the larger PUD.
And how much does it cost to build a golf course? That was a question I forgot to ask. An 18-hole golf course, championship level golf course with the clubhouse and lockers and the carts. What does that cost to get going?
Well, I you're not going to like the answer, because the answer can be as little as a couple $1 million, or it could be as great as $30 million. It depends on so many things. It depends on the type of turf grasses you're using, what type of irrigation system you're using, what kind of golf cart paths you're putting in. There are so many factors that influences how much dirt you need to move to create some kind of topography, what you're going to use for fill, what you're not going to use for fill, what your water source is. Do you need to build wells? Do you need to then line retention ponds? All of those things affect the cost. And one of our senior underwriters for golf has a sign in his office that says, "The losses of golf are directly proportionate to the size of the clubhouse." So that influences the cost as well, and the cost of operation. So it's not an easy question to answer. And then you start with, are you building this golf course in Florida, or are you building it in Vermont? And if you're building it in Vermont, you now have to clear X hundreds of acres to develop fairways, etc.
Right. Well, Jerry, this was a very educating conversation. On behalf of the Yieldstreet team, I want to say thank you for your time. We got some great questions from users out here today. Thanks for your expertise on golf and other things as well. I value our friendship and our partnership. And for everyone else, please go back to Yieldstreet, www.yieldstreet.com for any deal offerings. And everyone have a great day. Take care.